Hey, I'm Jason. Welcome to Supply and Demand Daily. I keep tabs on the economy so you don't have to. Today we're going to be talking about the Fed at the end, towards the end. We're going to talk about small business optimism and their reports of earnings and employment and production costs and things like that. And we're going to talk about OPEC, the Organization of Petroleum Exporting Countries, which released its monthly report for May 2022 today. And that showed that OPEC production was once again down, that oil production among the OPEC countries was once again down for the somethingth consecutive month. I think it's been at least 6 months now, because I'm going to share a headline back from December of 2021 that showed that they were missing their production targets at that point as well. So it's been at least 6 consecutive months of missing production targets, which, if the history of OPEC shows anything, that's really not supposed to be what happens. Not at all. If anything, the OPEC countries should be fighting with each other over which ones are increasing their production above quota, which the way that their system works is that they agree to quotas in order to maintain prices where they want them to be. And so you would think, at least historically, decades ago, there would be higher production with oil prices being what they are right now, but instead we see lower production, right? So that is certainly very interesting and casts doubt on the supply of OPEC spare capacity. But we'll get to that in a minute. Actually, we'll get to it right now. So oil prices spike as OPEC reveals production loss for May. The biggest losers were Nigeria and Libya, which actually shut down a major oil field, or I think it was a refinery actually, yesterday. OPEC produced a total of 28.508 million barrels per day in May, and OPEC production fell by 176,000 barrels per day compared to April, which is, on the face of it, not very much, but again, they're supposed to be increasing their production, not decreasing, and these are the countries that are supposed to have all of the oil reserves in the world, or at least a really big chunk of them, so this is not good news, unless your main priority is keeping carbon out of the atmosphere at the expense of literally every other human priority in the universe. Then you would probably call this a good thing, but that's not me, and I would hope that it's not you either. OPEC misses oil production targets once again. That is a headline from December 1st, 2021. So this is an ongoing problem for sure. To move on, the world rig count. This is the number of oil and gas rigs that are currently in operation throughout the world in OECD countries, in OPEC countries, and in countries that are not OECD and not OPEC. So this is all of the oil and gas rigs, is still significantly below where it was in 2019. So we had about 2,200 oil rigs going at any given time, and we are about 400 short of that now in 2022. So, and this is happening despite a forecast of increasing demand over at least the next year. So in a lot of countries, the concurrent with the OPEC report, or included in the OPEC report, I should say, is a demand forecast by different countries and groups of countries. So on this chart I'm showing here, I will go ahead and read off because the type print is probably pretty small on your phone, but we have Americas, as part of that, the United States, Europe, Asia Pacific, total OECD, China, India, other Asia, Latin America, Middle East, Africa, Russia, other Eurasia, other Europe, and total non-OECD. And some things that I wanted to call out here is that China, oil demand in China is actually projected to grow the most, even though they have had some pretty lackluster economic growth going back over the last year, and even in the year leading up to the COVID-19 pandemic. Indian oil demand is next on the list. It's projected to go up 9.2%. And also, it was really interesting to see within the OPEC report that the PMIs, that is the purchasing managers indices for different industries in India, are actually among the higher ones in the world right now. We'll look at what the global PMI looks like, which is basically an index of business conditions taken based on the surveys of purchasing managers within various types of companies, both in manufacturing and services. I have a chart that's going to show more what that looks like here in a couple slides, but India actually looks quite a bit better right now than the rest of the world. The U.S. is going to increase its oil demand by 3%, according to forecast, by the end of the year. Africa, the nations within Africa, is going to go up by 5.2%. Latin America is going to go down. I imagine that reflects the poor condition of most of the economies in that part of the world. And non-OECD, that is the Organization of Economic Cooperation and Development, which I believe contains, I don't know, somewhere around 20, 25, 27 countries, something like that, is 6.7%. So you have a lot more growth outside of the OECD than you have within the OECD, because this line right here, which I believe is 0.2%, so 0.5% effectively. So you have a lot more demand growth. You have a lot more demand growth outside of the OECD, and a lot of that is just tied to projected economic growth. So there's a lot more economic growth projected outside of the OECD than there is within. Industrial metal stocks are dropping and dropping fast. So on the on the left-hand side here, what I'm showing is the indices of prices of various commodities going up over the last couple of years, from May 2020 to the current, or the previous month actually. So you've seen some outright doublings here and even some triplings. And then what I'm showing on the right-hand side, which is almost more interesting, is the drop in supply of a lot of different industrial commodities, industrial metals over the last year. And then again, this is from the OPEC production report. They report on a lot of interesting stuff that's not just oil. So a couple of things that I wanted to call out is that zinc is in shorter supply than it was a year ago, as are most of these things, but there's about a third as much zinc in stock at the London Metals Exchange than there was a year ago. For nickel, there's a little less than half, and for aluminum, there's also about a third of the stock that was at the London Metals Exchange available than there was a year ago. Now, if this is particularly important if you see the energy crisis and you may be somebody who is of the persuasion that the solution to all of this is to basically build a gigantic fleet of electric vehicles so that nobody needs to fill up their car at the gas station anymore, or maybe dump a bunch of investment into windmills and solar panels so that people don't have to pay for natural gas anymore, and all of these different things. The issue with all of those plans are they require this. They all require this. There's no way to make that happen without more of this stuff, and this stuff is in incredibly short supply. And you're also going to need the energy commodities that you intend to get rid of in order to actually produce those things. Because one thing about producing capital goods, which windmills and solar panels are included in that list because they are goods that are used for producing other stuff, that stuff being energy, is they require some of the heaviest energy inputs of all of the different kinds of things that you could produce. So something to keep in mind while you're reading headlines about how we may be saved by some kind of massive green transformation in a couple years. Really what's needed here is a great deal more energy and a great deal more exploration for these sorts of commodities, and unfortunately, it seems to be a little bit further ahead in the future than most of us would like. So copper, on the other hand, even though there was a huge run-up in the price of that commodity in 2020 and in 2021, I believe, has actually fluctuated quite a bit, and we are sitting at a level that is at least comparable to a year ago. So at least we have some copper. That's a very important industrial metal, especially when it comes to things like electrifying certain pieces of the societal grid, like transportation. So global manufacturing and services PMI. This is the chart that I promised a couple slides ago. So we have the index was sitting at about 60 for services going back to May of 2021, and now we're sitting at 52.2. The way that these PMIs typically work, and I would say actually always work, is that anything below 50 is going to be a contractionary type of reading. And by contractionary, I just mean recession, less economic activity going on, less economic production, stuff like that. And the reason for that is because a purchasing manager's index is based on a survey, and the number comes from the percentage of the survey respondents who are reporting positive business conditions minus the percentage of the respondents to the survey who are reporting negative. So if I had, let's say, let's say that I have 70% of respondents reporting that their business is growing, then I have 70%, and then I have 20% who are saying that it's not growing, it's actually going the other way, that it's shrinking, that their business is getting worse, then that would give me an even 50. At least I think that's right. Yes, that is correct. I do have that right. All right, so, and there may be another piece of the calculation that I'm missing. Yeah. So anyway, anything below 50% essentially means contraction, and the data going back decades and decades since these things were first created really bears that out. So it's not just the United States. I typically will I share the different sorts of PMI indices that we have in the U.S. I share them whenever they come out, and I haven't done much sharing of global PMIs, even though I'm actually going to here in the future. But as you can see, when you average all of them together, it paints a picture that it's not just the United States that is moving in this direction of economic contraction. It is, in fact, most of the world as well, except for India. Like I mentioned before, the chart for India looks basically like, I think it was sitting at about 56, 58, something like that. So significantly higher than the rest of the globe. And then the Fed tomorrow. The Fed is going to make some decisions. It's going to make at least one decision, maybe two, maybe three, but it's going to tell us tomorrow what its target range for the federal funds rate is. Now, the reason that the Federal Reserve manipulates the federal funds rate is this is an overnight interest rate that basically sets it's kind of a base rate for borrowing costs on a short-term basis for a lot of different kinds of financial and non-financial companies. So if you drop the federal funds rate down to zero, the chances are that you will also have very low interest rates on things like commercial paper, which is basically a 3-month loan to a company for them to go and use to carry on their operations. And then at the end of the 90 days, they pay you back. So that's one example. It'll drop the short-term rate, or it'll drop the rate on short-term U.S. government bonds. And then a lot of other short-term borrowing costs are benchmarked on that. And so for a lot of companies, a great deal of very large companies, this short-term overnight rate will have an effect on how much it costs them to borrow, by and large. So what the Federal Reserve does is when they want to increase the expansion of credit, and by the way, I'm not saying that it actually ends up working as mechanically as I'm about to explain. There's a lot of other effects that kind of dilute the net effect of these rate changes. Right, but according to the Federal Reserve's framework, their analytical framework, their worldview, the way that it works is when they want to expand credit and they want to expand economic activity and they want to, quote, stimulate the economy, that's the word that you'll usually hear, they will drop the federal funds rate because that lowers the cost of borrowing for various different kinds of companies, both financial and non-financial. And then that, gives them the ability to invest or carry on their operations and stuff like that. Now, when there is an inflation problem in the economy, like in May of this year, when we got a reading that said consumer prices increased 8.6% on the year, well, then their thinking is that increasing the federal funds rate slows the economy down. So they believe that the economy is overheating. We have too many wage increases. Again, this is their framework, not mine. But they believe that we have too many wage increases. The economy, all of the resources in the economy are being used at full capacity. capacity. And so this is creating inflation. And so what they want to do with this interest rate is start to cut off demand. And unfortunately, the implication there, again, their framework, is that in order to get inflation down, there needs to be some unemployment. There needs to be more slack in the use of resources. Now, the fact of the matter is that inflation is really driven by credit creation ultimately. So if there is a drop in the amount of credit that's being created or an increase in the amount of credit that's being created, then that is going to put the demand pressures on all the goods and services in the economy, which is going to make their price go up. And the time to really think about that was, in fact, a year and a half ago, before we started to really see this inflation business start to get out of hand, and the Fed is certainly late to the party here. But anyway, there is an indicator within financial markets that's called the federal funds futures contract. And what that is a bet on the direction of the federal funds rate. And companies use it in order to limit their exposure to what's called interest rate risk. The risk that I'm going to need to borrow some funds in a month and a half, 2 months, 3 months. And between now and then, I know that I'm going to have that need, but between the time that I know that I have the need and the time that I actually have the need, the time that I need to go into the market and do it, the cost of doing that borrowing might go up quite a bit. And so the federal funds futures contract and other types of interest rate contracts allow companies, usually financial ones, to mitigate that risk, to sort of eliminate that risk. And so it's thought by practitioners and definitely by the Federal Reserve that if you look at the implied rate on these contracts, the implied interest rate, that tells you what the market is expecting the federal funds rate to be whenever that contract expires. And so what we're looking at, the blue line here, first of all, what I'm showing you here, the orange line is the actual federal funds rate right now. All right, so it's sitting at 0.83%, and you can tell by the flatness of this line that it's not a very active market. So that's one thing to pick up from there. But what this blue line is showing is the implied interest rate on the contract that Fed funds futures contract, specifically the one that expires at the end of June. At the end of this month, at the end of June 2022. And so the way that markets look at this and the way that the Federal Reserve looks at this is that this is what financial markets, this is what traders within the Fed funds futures market are expecting that rate to be at the end of June. And often what the Federal Reserve does, what the Open Market Committee, this is the council of people who get together and decide what this federal funds rate is going to be, if you go back and you read their transcripts, which I often do, the first thing that they talk about is exactly what we're looking at here. They look at this line. They will look at the expectations, or what they think is the market's expectation of what the Fed funds rate is going to be at different intervals in time. So they'll look at it for June 2022, and they'll look at it for September 2022 and December 2022, and so on and so forth. And figure out, they will base their decision, a lot of their decision, on that. So a lot of people might think that the Fed sits down with a bunch of macroeconomic models that are super technical and statistical and do this complicated quantitative analysis in order to figure out what the optimum rate is going to be. And that's not really true. A lot of what they do is they look at what the market is thinking based on this futures expectation that I'm showing you here, or what they think is an expectation. And they will basically decide in relation to what that is saying. They'll decide if they want to shock the market or if they want to fall within the market's expectations. And there's, they do look at some economic indicators, but again, if you go back and read their transcripts, this is basically the first thing that they talk about is what they can derive from different market prices, different market interest rates to try and gauge what the market is expecting. So this is what they do. And so what is it telling us right now? Well, it's telling us that we're going to get a rate hike from, so by the way, I should have mentioned this earlier, but the federal funds target range right right now. You see that the actual rate is 0.83%, and that is falling basically not exactly in the middle, but it's falling within the current target range of 0.5 to 1, 0.75% to 1%. And the projected rate hike that we get from this Fed funds futures rate is that the range is going to go up from 1% to 1.25%, and that would be a 25 basis point hike. I mentioned this before, but a basis point is simply a hundredth, 1 over 100 of a percentage point. So it's basically the market is saying, or the way that anybody in the financial press would read this, is the market is pricing in one rate hike of 25 basis points. So that's how that goes. And then last but not least, the National Federation of Independent Businesses Index. So this was the fifth consecutive month, or at least May 2022 was the fifth consecutive month that the NFIB Small Business Index has been below the average, the long run average going over 48 years of 98. And I'm showing this red line here is basically the level that it's at now, a level of 93.2%, and how that compares to previous. So there was a big surge in the small business index, basically right in line with the Trump administration. And I've even heard that this is basically because a lot of small business owners are in fact Republicans. So this Peter Schiff, if you know who that is, Peter Schiff's theory about that was simply that, a lot of small business owners are Republicans. And so when Trump got elected, they were really excited about that. And so their optimism went way up during that time. So that's one way to look at it. But moving on, the big kicker out of the report today was really the expectations. So there are a couple of questions that are asked on the survey. Do you think it's a good time to expand based on general business conditions? And do you... do you expect business conditions to be better in general or worse over the next, I forget what the time interval is, I think it's 6 months. And so on that second thing that I mentioned, we're looking at the thinner line here. That share of people, that share of business owners who are expecting conditions to be better in 6 months' time has gone down to a 40-year low. So it's lower than it has been in the history of the index, which is pretty insane, actually. And maybe it is just because most small business owners are Republicans and they don't like that there's a Democrat in office. I don't know. But it does line up with the expectations from purchasing managers in both the services and manufacturing surveys that we've looked at in previous days and weeks, certainly. Their 6-month expectations are not great either. And it lines up with consumer expectations as well. So, and then just one more thing. I didn't, this is the first time that I looked at this detail within the survey, but the actual normal for small businesses based on their earnings is to actually be losing money. So what this is showing is an index, basically showing the percentage of business owners who are reporting that their earnings are going up minus the percentage of business owners who are reporting that their earnings are going down. And as you can see, when you go through the history of this index all the way back to 1986, most readings are below zero. So that means that the majority of business owners surveyed, majority of small business owners surveyed, for them, the norm is actually to be having lower earnings than the previous, than 3 months ago. This is a 3-month earnings growth question. And so where are we at with that? We actually got to, prior to the pandemic, we crested a tiny, tiny bit above zero for the first time ever. But now we are slumping back down, or small businesses are slumping back down more into more into a recessionary type of territory. You'll see these dips here. We have the bursting of the tech bubble in 2000 and 2001, and then we have the 1990 recession in 1990 and 1991. And then this huge divot here, as you may have guessed, is the great financial crisis that resulted in one of the longest economic depressions on record. You can call it a recession, you can call it a depression, whatever you want to. I prefer to call it a depression because it kind of was one. So, for small businesses, a smaller or, shrinking earnings for the majority of the small business is actually the norm. That's pretty crazy. So, and then one more thing that I did not put in a slide, but that I noticed is that a few weeks ago, I shared that among manufacturers, about 75% were reporting on that survey. This was a PMI survey. We're reporting on that survey that their input costs were increasing. And the same is actually true for the small business, for this small business survey. So about 77%, it was somewhere between 75 and 80% of respondents were still reporting increasing input costs. So I thought that was definitely noteworthy as well. And what does that signal? Well, it means that there's probably not, because that level has been elevated for so long, it means that the inflation that we see is, an end to it is probably not close in sight. All right, and then what am I going to talk about tomorrow? That's all I got for you today. But what am I going to talk about tomorrow? Well, we're going to look at what the Fed actually does. So a couple slides ago, we talked about what the market thinks that they're going to do and what I think they're going to do, because they just watch the market. That's basically their formula. And so they're going to make that announcement, and we're going to see how different markets react. It's a big day today, actually. We got retail sales. We have a home builder industry index, and we have inventories. That's retail inventories. So stay with me for tomorrow. Hope you'll enjoy that. Hope you enjoyed today. If you have any comments, feedback as to how these things can be made better, please don't hesitate to reach out, whether that's via comments or DMs or whatever. And I hope you enjoy the rest of your Tuesday. Have a great evening, and I'll see you back tomorrow for Supply and Demand Daily. Thank you very much.